peace just broke out in the Persian Gulf this week. The Strait of Hormuz is reopening to global shipping. Uranium equities rallied hard on the news, and yet the physical price of uranium did not move a single solitary cent.
Yeah, it is the absolute definition of a market paradox.
Totally.
I mean, traders were popping champagne over peace in the Middle East, while the utilities buying the actual nuclear fuel just, shrugged. They looked at their empty inventory sheets and just kept paying top dollar.
Paper trays panic, right?
Yeah.
But physical supply just does the math.
Exactly.
So welcome to this midweek deep dive. It is Wednesday, June 17th, 2026. And for those of you joining us, our mission today is very specific. We are taking the stack of midweek market reports, the geopolitical alerts, the mining press releases, and we are going to untangle two completely conflicting stories that the broader market has just spent the last year confusing.
Right, because on one hand, you have this massive geopolitical de-escalation playing out in real time. But on the other hand, you have a physical supply reality that seems to be operating in an entirely alternate universe.
Yeah, so what we're really looking at here is a real-time stress test of the entire uranium bull case, right?
That's exactly what this is. We're tracking market movements from Monday through today. We're focusing on this new United States and Iran Memorandum of Understanding, and we're examining some major structural supply shifts happening quietly in Africa and Canada.
And really analyzing this fascinating decoupling between the stock market and the actual physical commodity market.
Yeah.
So let's start with the loudest headline of the week, because it perfectly illustrates why the market's initial reaction might actually be deceiving you. Monday morning, the news breaks across every terminal. The U.S. and Iran agree to a memorandum of understanding.
Right, the MOU.
Yeah, the MOU. They establish a 60-day negotiating window over Iran's nuclear program. And specifically, we're talking about the disposition of their roughly 408-kilogram stockpile of 60% enriched uranium.
Which is significant.
Very significant. But crucially for the global markets, this deal immediately reopens the Strait of Hormuz to toll-free international shipping. The digital ink is dry, and a formal signing ceremony is set for this Friday, June 19th, in Geneva.
Which is just a massive geopolitical event. I mean, for 18 months, bears in the uranium market have been waiting for this exact headline.
Yeah.
The thesis was always that, the moment the conflict risk evaporates, the price of uranium will just collapse back to historical averages.
And the equities market reacted exactly the way anyone reading a textbook would expect.
Yeah, the relief rally.
Right, a relief rally across the board. Cameco jumps about 3.5% to around $104.50. Yellowcake is up nearly 3% in London. And the big uranium ETFs catch a broad bid.
Because the war premium is raining out, right? Portfolio managers are finally breathing a sigh of relief.
Exactly. But, and this is the big but, if you want to know what is actually happening in the industry, you cannot just look at the stock tickers. You have to look at the physical price of the metal.
Yeah, you have to.
Because despite the single largest geopolitical overhang on this entire sector lifting on Monday, the physical spot price stayed dead flat. $86.10 a pound.
It did not budge.
Not a single cent. And add to that the term price. The price utilities pay for long-term contracts to ensure their reactors don't go dark, that is sitting near $95.
Maintaining that rigid $9 spread above spot.
Yes. That $9 premium is the true signal here. It didn't blink once at the prospect of Middle East peace.
No, it didn't.
It's like turning off a blaring fire alarm in a house.
Right.
The alarm has been deafening for months, taking up everyone's attention. Finally, someone flips the switch. You almost expect the whole foundation of the house to settle because the noise finally stopped. But nothing shifts.
Right, because the house is built on bedrock, not the alarm.
The alarm was just a distraction.
Yeah.
But I have to ask, why? Why did the physical market completely ignore its biggest geopolitical catalyst?
Well, because the structural constraint on uranium was never actually about the war in the Gulf.
Right.
The price floor we are seeing is held up by two immovable forces: record uncovered utility demand and supply geography.
Okay.
The physical market realized very quickly that, sure, toll-free shipping through Hormuz is wonderful for global oil and consumer goods trade, but it doesn't suddenly materialize millions of pounds of Western-aligned uranium that simply, do not exist yet.
So the physical shortage is just mathematical, regardless of who is getting along in the Middle East.
Exactly.
Let's dig into the caveats of this Iran deal, too, because impartially looking at the sources, it's not a magic wand. We're just reporting what's in the text here. This is a 60-day framework, right? not a permanent binding treaty.
Right, it's a window.
And Israel is not bound by this agreement whatsoever. Furthermore, Iran's highly enriched stockpile remains physically locked away from civilian markets.
And that last point is so crucial for understanding the market mechanics. 60% enrichment is highly enriched, bordering on weapons grade.
Right, and commercial nuclear power plants run on low-enriched uranium, usually around, what, 3 to 5%?
Exactly, 3 to 5%. So even if a diplomatic miracle happened and that Iranian stockpile was released to the open market tomorrow, it cannot just be shoved into a reactor in France or Pennsylvania.
It has to be processed first.
Right, it would have to go through a very complex, time-consuming down-blending process at specialized facilities. It does not just hit the spot market on Monday morning.
Which means the geopolitical risk floor is lower than it was last week, certainly. But the structural bull case survived the peace outbreak entirely intact.
It really is the ultimate stress test.
Yeah. So if the price floor isn't built on war fears, what is holding it up at $86? It has to be supply. And Monday's mining updates show exactly how tight that supply is.
Oh, absolutely.
Let's look at the actual physical reality driving this market beneath the surface. Because while the mainstream financial press was entirely focused on the Persian Gulf on Monday, there were some massive foundational moves happening in the mining industry.
Moves that will literally dictate the next decade of energy security.
Right. So let's start in Africa. On Monday, uranium veteran John Borshoff, the man who literally built Paladin Energy into a powerhouse, was named interim president of Forsys Metals.
Taking the permanent CEO chair on July 31st.
Right. And his primary mandate is to develop the Narasa project in Namibia. And if you stack that with other recent news, the blueprint becomes pretty obvious. Just prior to this, we saw Cameco and Orano buying out TEPCO's 5% stake of the Cigar Lake mine in Canada.
For roughly 115.75 million Canadian dollars.
Exactly, which takes that Tier 1 wine to 100% Western-lined ownership. Plus, over in Malawi, Lotus Resources' Kailekera mine is officially hitting nameplate production.
Yeah, and the way these seemingly isolated corporate updates form a single coherent narrative is just fascinating when you step back.
How so?
Well, the industry isn't just trying to blindly dig more holes in the ground to add a few more pounds of production. The Western supply base is professionalizing and actively consolidating its safest assets.
Okay, let's break down why those specific moves matter for the listener. Having someone with John Borshoff's pedigree returning to lead a Namibian developer, I mean, that's a massive credibility stamp.
Huge. It signals to institutional capital that Namibia is the primary battleground for non-Russian, non-Sahel uranium.
Right. It essentially validates the economics of the Narasa project.
Yeah.
And then you jump over to Canada. Cameco and Orano taking Cigar Lake to 100% ownership is a very surgical move.
Yeah.
By buying out TEPCO, they are cleaning up the cap table.
Removing a Japanese utility that has been undergoing endless restructuring since Fukushima.
Right. And they are concentrating control of one of the world's highest grade assets into the hands of two aligned Western majors.
And you see this with Lotus Resources in Malawi hitting nameplate production, too. Hitting nameplate means they are no longer in a speculative testing or ramp-up phase.
Right.
The facility is now extracting and processing the maximum daily tonnage of uranium it was originally engineered to handle. The operational risks are fading.
Okay, wait. I need to push back on this for a second. If we have all these projects successfully ramping up, Malawi delivering its max targets, Namibia attracting top-tier capital, major mines consolidating their operations, basic economics would suggest that more supply coming online should drive the commodity price down, right?
I think so, yeah.
We're talking about expanding and securing production across two continents. Why is the market viewing this as a bullish signal that justifies a $95 term price?
Well, that goes straight to the heart of a distinction that nuclear utilities understand perfectly, even if, retail traders sometimes miss the nuance. The current market dynamic is not about total global supply. It is entirely about aligned supply.
Meaning jurisdiction matters more than geology.
Exactly. The geopolitical map of uranium has been permanently redrawn over the last 3 years. With Niger experiencing its military coup and essentially being lost to the Eastern Bloc.
Kicking out French and American interests.
Oh.
Right, just reporting what happened there?
Right. The entire supply geography for Western nuclear reactors had to shift overnight. It has to move south and east in Africa towards stable mining jurisdictions like Namibia and Malawi, and it has to consolidate in bulletproof jurisdictions like Saskatchewan, Canada.
Got it.
When utility fuel buyers are looking at the market right now, they aren't just paying for spot availability. They are paying for supply durability.
They need absolute certainty that the uranium will actually be put on a boat and show up 5 or 10 years from now, regardless of what government collapses in the Sahel or what shipping lanes get contested in the Middle East.
Because a utility running a multi-billion-dollar nuclear plant simply cannot fuel it with promises or politically compromised supply. A reactor going offline because of a fuel disruption is an unmitigated financial disaster.
Right.
So when these utility buyers see industry titans like Cameco and Borshoff consolidating and advancing aligned assets, it actually reinforces the reality that the secure supply pool is incredibly tight. It is being aggressively locked up by the biggest players.
So it's the exact mechanics of buying insurance. You don't buy the absolute cheapest policy from a fly-by-night company that might go bankrupt when you actually need them.
No, you gladly pay a premium for the blue chip provider because you are paying for the certainty of the payout.
The utilities are pricing in the cost of certainty.
They are looking at a fragmented market and deciding that a $95 term price is a bargain for guaranteed Western-aligned delivery in 2030.
Which brings us to the ultimate proof of conviction. Because talk is cheap in the mining sector, press releases are cheap. Capital, however, is extremely loud.
Very loud.
And that leads to the quietest yet loudest move of the entire week. On Monday, Yellowcake, the physical uranium trust trading on the London Stock Exchange, launched a $10 million share buyback.
If you want to understand insider conviction regarding that $86 price floor, you look no further than this transaction.
Normally, a share buyback is standard corporate finance, right? A company uses excess cash to retire shares and boost earnings per share.
Right.
But Yellowcake isn't a normal company. They don't operate mines or sell software. They essentially act as a holding company. Their primary asset is physical uranium, sitting in a highly secured vault. So if they are buying their own stock, the implications are very different.
Let's look at the arbitrage hiding in plain sight here. Ideally, Yellowcake's share price on the stock market should perfectly match the value of the uranium they hold in that vault, their net asset value, or NAV.
Okay.
If they hold $100 million in uranium, their market cap should be $100 million. But markets are rarely perfectly efficient due to broader market sentiment, liquidity issues, or general macroeconomic fear. The share price will sometimes trade at a steep discount to the value of the actual uranium they own.
So the stock market is pricing their equity at a discount to the physical spot market. You can essentially buy a claim on a pound of uranium through their stock for less than it costs to buy a physical pound of uranium on the open market.
Exactly. And Yellowcake's management looks at this discrepancy and faces a choice. They could take their $10 million in cash and go buy more uranium on the spot market at $86 a pound.
Right.
But if their own stock is trading at a steep discount to the physical metal, the absolute cheapest uranium they can possibly buy is their own shares.
Wow.
By launching this buyback, the corporate sector is declaring to the world that the physical pound is significantly undervalued by the broader market. They are so confident in the enduring structural value of the metal in their vault that they'll use their cash to buy themselves.
It is pure conviction expressed in capital.
Yeah.
I mean, they aren't going on financial television saying they think prices will go up. They're putting $10 million on the table that says the market is pricing physical assets incorrectly, and they're taking advantage of the arbitrage.
And the timing is the real tell. They launched this buyback on the exact same day the U.S. and Iran deal was announced.
Yeah, they looked right past the flashing geopolitical headline, ignored the opening of the Strait of Hormuz, and just trusted the structural deficit.
Absolutely.
So with that setup from Monday to Wednesday, the geopolitical phantom relief, the physical supply consolidation, and the insider capital conviction, what should you, the listener, be watching as we head into the back half of the week?
Well, the dust hasn't fully settled yet, and Thursday and Friday are going to bring their own immediate tests.
Right. These next 2 days are confirmation tests. We have spent the first half of the week separating the geopolitical trade from the structural trade.
And the back half of the week will prove if that separation holds up to direct pressure.
So what are the specific catalysts on the radar?
Test number 1 is the actual Geneva signing on Friday, June 19th. We are moving from a digital handshake to a formal diplomatic ceremony with cameras in the room. What you need to watch for is any hardline disruption. Does the Israeli government issue a statement condemning the framework? Do hardline factions within Tehran push back on the parameters?
Right.
But more importantly, once the ink is physically dry and toll-free transit through Hormuz is officially operationally open, does the physical price of uranium continue to ignore it?
If the spot price stays completely flat while the oil tankers roll through the Gulf freely, the bull case has basically been validated under the most adverse possible headline for the bears.
Exactly. The ultimate proof of the bedrock.
Yeah. And the second catalyst.
The second massive catalyst is the positioning for the Kazatomprom Extraordinary General Meeting, which takes place on Monday, June 22nd.
And for those newer to the space, Kazatomprom is the state-owned operator in Kazakhstan. They are essentially the Saudi Aramco of uranium, responsible for a massive percentage of global supply.
The world's absolute largest producer. Now, the primary official agenda for this EGM is simply board re-elections, standard corporate governance. But you have to listen closely for any supplemental commentary or forward-looking statements regarding their 2026 production trajectory. In the first quarter of this year, they tracked at a production pace of 6,144 tons of uranium.
And the world's largest producer rarely speaks without causing a ripple effect.
Right.
And for those tracking the mining mechanics, we have to talk about how Kazatomprom actually extracts that uranium, because it dictates their vulnerability. They don't dig massive open-pit mines. They use a method called in-situ recovery, or ISR.
Yeah, ISR.
They essentially pump a chemical solution, primarily massive quantities of sulfuric acid deep underground, to dissolve the uranium directly out of the porous sandstone, and then they pump the uranium-rich solution back up to the surface to be processed.
And that specific reliance on sulfuric acid is their Achilles heel right now. The global supply chain for industrial chemicals is severely bottlenecked.
Right, because agricultural fertilizer production and base metal refining are competing globally for that exact same sulfuric acid.
Exactly. So if Kazatomprom uses this EGM to signal any struggles in securing enough acid to meet their forward guidance, or if they lower their overall production expectations for 2026 because of these chemical shortages, that will send absolute shockwaves through that $95 term price.
Because if the Saudi Aramco of uranium admits they can't get the basic chemicals needed to maintain their extraction rates, utilities will panic buy to secure whatever supply is left.
Which is exactly why every utility fuel buyer on Earth will be reading the transcript of that meeting on Monday.
Wow. So what does this all mean for you? If you take nothing else away from this midweek deep dive, let it be this. You have to completely separate the geopolitical trade from the structural trade.
Absolutely.
This week proved unequivocally that the equity relief rally, the mining stocks popping because the Strait of Hormuz opened, is entirely divorced from the physical reality of the metal, which just stayed relentlessly flat at $86.10.
Yeah.
You now have the analytical tool to look past the blaring headlines on your newsfeed. Do not watch the politicians shaking hands. Watch the term-to-spot spread. Watch the aligned supply consolidating in Namibia and Canada. Watch where the institutional capital is flowing, like that yellow cake buyback.
Yeah, and I want to leave you with one final thought to chew on as we wrap up.
Okay, what is it?
We have spent this entire deep dive talking heavily about supply constraints. We've dissected mining consolidation, transit routes, in-situ recovery mechanics, and physical deficits. But we have completely ignored the other side of the equation.
Which is?
What about the demand side?
Oh, right. We really haven't touched on demand at all, other than noting that utilities are uncovered.
Right. And there is a major catalyst flying entirely under the radar this week. Next Friday, June 26th, the New York Power Authority, NYPA, officially closes its request for qualifications. This isn't just another utility buying fuel for an old plant. NYPA is the largest state public power organization in the United States. This short list of reactor developers is going to represent the first serious state-level procurement mandate from America's largest state electricity market. They are actively looking to build out massive new nuclear capacity.
That is a total paradigm shift.
Yeah.
I mean, we aren't talking about private utilities extending the life of a 40-year-old reactor by a few years. We are talking about state entities preparing to mandate and fund entirely new reactor builds.
Exactly. So I want you to consider this as you watch the market next week. If the physical market is this incredibly tight right now, just trying to satisfy the current uncovered demand from existing utilities competing over dwindling alliance supply.
Yeah.
What happens to that $86 price floor when massive state power authorities start locking in fuel for entirely new multi-decade reactor
The
platforms?
house is built on bedrock, and suddenly the biggest state utility in the country wants to add a second story.
The math is going to get very interesting.
It really is. Thank you so much for joining us for this deep dive. Keep questioning those headlines, keep looking for the bedrock beneath the noise, and we will see you next time.